Now, welcome everyone to our third session of cost of capital, where we are discussing the important concepts related to the way the firm raise capital. So far, we have studied in the cost of capital, we have studied about the way the firm can raise capital by equity and debt, the theoretical aspects of equity and debt we have discussed. Okay, then we have discussed about the calculation of redeemable and irredeemable cost of debt. Okay, how it can be calculated. Okay, either with the shortcut formula or either with the approximation formula. We have discussed this formula. So here this YTM is nothing but it's a cost of debt. Now we have reached the third session. In the third session, we are going to start our class with the amortization of the bond. So guys, talking about bonds, you know that in the case of bonds are basically whatever the numericals I have discussed. These are basically non-amortizing component because till their maturity, you are just paying the interest to them, and then on the maturity, we are giving them the face value. So these are basically called as non-amortizing debt instrument. In case if we have a amortizing bond, in case if we have an amortizing bond, amortizing basically means okay, amortization of bond. Amortizing basically means that you are paying a part of principal here, which is like an EMI. So you are paying a part of principal that will reduce the the principal component till its maturity. Like the way you remember how we calculate the EMI of a loan, that same logic you can use here also when it comes to amortizing of the bond. Here, basically what happens like whatever is the life of the debt instrument, whatever is the life of the debt instrument, okay, what we do, we pay here in the case of in this amortizing of the bond, there would be a principal, there would be loan amount which need to be paid, and then in order to pay this loan amount, okay, whatever is your loan amount, will pay in fixed amount here, a fixed amount like an EMI or whatever is paid. Okay, and by paying this fixed amount, what you'll do, you'll try to calculate your interest. Okay, you'll try to calculate your interest, and since the interest will keep on decreasing because every time you'll pay the fixed amount and your principal is going down, because whatever you paid extra is nothing but your fixed amount minus interest. Okay, that will reduce your principal. So because your principal will reduce, so every time the interest will be reduced, and when the interest will reduce, the automatically on the maturity, the loan amount will become zero. So we're going to talk about the application of this in this class. So when we have amortization of bond, so a bond may be amortized every year. Bond is repaid every year rather than on a maturity. That means the part of principal, what we call is amortizing of the bond. In such a situation, the principal will go down with the annual payment, and the interest will be computed on the outstanding amount, what I explained you, and the cash flow of the bond would be uneven. Okay, like here there's a question that this company called RBML, they're proposing to sell a 5-year bond of 5,000 rupees at 8% of interest per annum. Okay, so the principal is 5,000 rupees and 8% of that would be 420. No, no, not 420. 8 5 is 40. So I think it would be 400. So 400 would be the interest, okay, which they'll calculate. The bond amount will be amortized equally over its life. Calculate the bond present value for the investor if you expect a minimum return of 6%. So 6% you consider as the cost of debt here. Okay, so now in order to do this problem, okay, let me just make a note of the statement that the life of the instrument is 5 year. Okay, and the amount what they have taken is 5,000 rupees. Okay, and it is 8% interest per annum. Tax rate is not given. Okay, and the cost of debt is given as a 6%. Okay, now if we go further and understand this, I have explained this question. The life of the instrument is 5 year. The outstanding amount, okay, first 5,000 rupees is the price of the instrument what is being taken, and 8% of that, okay, so 400 rupees. 400 rupees would be the interest. Okay, assume that the ₹1,000 is the principal, what is being paid. Okay, here although the face value is not given, so assuming that the ₹1,000 is the principal what is paid, and the YTM is 6%, so the what is paid at the end of first year is 1,400. So if I find the present value of this 1,400, because the cost of debt is 6%, so you will get as 1,320.754. Then next year, because we have paid ₹1,000. How we paid ₹1,000? Because the life of the instrument is 5 years, and the amount of loan was ₹5,000. The amount of loan was ₹5,000. So how much the installment means equally payment what is being paid in the form of EMI, that is ₹1,000. So ₹1,000 is paid every year. Okay, so then next year the amount loan outstanding is 4,000. On 4,000, 8% is the rate of interest, that will be 320. Then again ₹1,000 is paid. Now total paid is 1,320. And then if I find uh, the present value of 1,320, divide by 1 plus 6% to the power 2, because this is paid after 2 years, I'll get this value. Then third year, the value left is 3,000, and then 8% of 3,000 would be 240, and again ₹1,000 principal is paid. Then total paid is 1,240, and then I'll find the present value of this 1 plus 6% to the power 3, I'll get 1,041. Again, then 8% of this is 160, then 1,160 divide by 1 plus 6% to the power 4. Okay, I'll get ₹918. Then 8% of 1,000 is 80, and 80 plus 1,000 you will get 1,080. And 1,080, if you find the present value of 1,080 for the 5 year, fifth year, means we will get is 807. Okay, and then if you do the total sum of this, we will get the sum total of present value is 5,262.545 something. So here the calculate the bond present value for an investor if you expect a minimum rate of 6%. So the present value of this bond is 5,262.545. Okay. Now you have understood about our those kinds of debt instruments which are irredeemable in nature. We have discussed about redeemable debt instrument. Okay, we have discussed the impact of tax, how it affect the cost of debt. That part also we have discussed. Okay, then we have discussed about the amortizing debt instrument. Now we'll talk about convertible debentures. So holder of the convertible debentures, they have option. Convertible debenture means you can convert them into equity in the future, has the option to either get the debenture redeemed into cash or get the fixed number of company shares. Okay, they have two options. Either they will mature it like a debt instrument, or either convert them into equity. The calculation of convertible debenture are very much similar to the redeemable debenture. While determining the redemption value of the debenture, it is assumed that all the debenture holder will choose the option which has the higher value and accordingly calculate the cost of the debt. So here on the maturity, you have two options. Either you convert that into equity or either you convert them into cash. So we'll see in both the case. When you're converting them in cash, okay, then what you need to do, you these need to assume as a redeemable instrument. You need to assume like it is a redeemable instrument and it is getting matured. And for the equity conversion, we'll follow the logic of how the calculation of equity model is done by Gordon model. We'll use that. So here there is a question that a company issued 10,000, 15% convertible debenture. So the interest here is 15% of, so 100 means 15 rupees. Okay, and the face value is 100 rupees. Okay, and maturity period is 5 year. Maturity period is 5 year. At the maturity, the debenture holder have the option to convert the debenture into equity share of the company in the ratio 1:10. Okay, the on the maturity, the debenture holder has the option to convert them into equity share in the ratio 1:10, means 10 share for one debenture. So here the company is issuing 10,000 debenture. So because the company is issuing 10,000 debenture they are issuing. So the total number of equity shares they can total shares they can dilute in the market. Imagine if 100% debenture get diluted into equity, then you will get 1 lakh shares in the market. Okay, I will not think about others. I'll just assume that I have one share of the company. I'll just assume I have one share, one debenture of the company. If that one debenture, if I convert into equity, if that one debenture I'll convert into equity, then I'll get 10 share of the company. Okay, the current market price of the share is 12 rupees. The current price of the share is 12 rupees and its growth rate is 5%. Okay, the current market price of the share is 12 rupees and the growth rate is 5%. And here you have to consider the tax rate as 35%, because you remember, right, I mentioned that whenever we are discussing problem of convertible debenture, you have to assume like a redeemable debt instrument, so which will be redeemed somewhere in the future, and then the tax rate will be used here. So the calculation of cost of debt when you have redeemable debt instrument is interest into 1 minus T plus face value minus price by N whole together, face value plus price by 2. This is the formula what we have discussed. The price is given as 12 rupees, growth rate is given, tax rate is given, the debenture interest rate is given. So here if you convert the debenture uh, into cash, the what is the cost of debt? This would be the cost of debt 15 into 1 minus 35% plus then the redemption value will come. What is the redemption value? So because here the we use either face value or redemption value. So I'll leave- I'll not take that, and price is 100 and the life would be 5 year divided by this plus 100 divided by 2. I don't know what is the redemption value. I don't know what is the redemption value here in my case. So because generally we use either the face value, or because if you just convert that, if you just convert it into cash, then you'll get 100 rupees. Then in that case, your redemption value would be 100 rupees. Or you have the option to convert that into equity. Okay. So what I will do here, so assuming that if you convert that into cash, you'll get 100 rupees, that is maturity. But if I convert, suppose if I'm having one debenture, if I convert that one debenture into 10 shares and the price of one share is 12 rupees, so the price of 10 share will be 120 rupees. Okay. And after 5 year, okay, after 5 year, what would be the future value of this share? Future value of this share 120 into 1 plus 5% to the power 5, that would be 153.12. Okay, so here the redemption value would be 153.12. Here the redemption value, here it would be 153.12. Here the redemption value would be 153.12. Based on this, if you'll calculate, you are getting around 16% as the cost of it. So here nobody will convert that into debt, because if nobody will convert into cash, because if you convert that bond into cash, you will get 100 rupees on the maturity, right? But if that same thing, if you are converting into equity and holding that in the form of equity, so the future value what you are getting for the equity, the redemption value in that case would be 153.12. So it make more sense to convert the debt into equity on the maturity, because you are getting a redemption value of around 153.12. So if you consider that you will hold it like a bond, then you are getting 100 rupees on the maturity. Your redemption value would be 100 rupees. But if you're considering it like a equity and assuming that whatever whatever you have the debt instrument, assuming that if you have converted into equity, then the redemption value, the opportunity cost, what we are talking about here. So because you have the feature of equity, so the redemption value what you get from the equity, because one debenture, if I'm having that, is equivalent to 10 share, and the price of one share is 12 rupees. So the value what I'm getting is 120 rupees. And if I consider the future value of that 120 rupees at 5% per annum, which is the growth rate of the equity, then the redemption value I'm getting is around 153.15. Okay, so we'll consider that. And that way, when we are calculating, we are getting a cost of debt of around 16.09%. Okay, now we'll talk about preference share capital. So the preference share capital is paid a dividend at a specified rate on face value of the preference share. Okay, the preference share, you know what is preference share? When so you have understood about debt instrument. Now, when we talk about equity instrument, there are two kinds of shares what the company issue. Either they are preference share or either they are ordinary share. Preference share, you don't get the voting right. You are not the owner of the company. Preference shares are always issued for a definite time period. And tomorrow, if the company will declare dividend, okay, or they will do any issue, or they if they are getting liquidated, the first preference is given to the preference shareholder. The preference share capital is paid dividend at the specified rate on the face value of the preference share. Payment of dividend to the preference shareholder are not mandatory, but they will get preference over the equity shareholder. And the payment of dividend to the preference shareholder are not charged as the expense, but treated as an appropriation of after profit. Whenever we are talking about dividend, so what is dividend? Dividend is the part of profit what we'll give to our shareholder. Okay, and this dividend is calculated after the payment of tax. So there's no tax shielding advantage. Okay, there's no tax shielding advantages when we talk about cost of equity. So here, when we are seeing the payment of dividend, it is paid after the payment of after the deductions of interest and tax. After that, what left is the net profit or profit after tax. On that, some part of that net profit is given to the shareholder as the form of dividend. And remaining part, what the company retained with themselves, is called a retained earning. Okay, so hence dividend is paid to the preference shareholder does not reduce the tax liability of the company. So whatever the company pay as a dividend to the preference or ordinary shareholder, it does not impact the tax liability of the company because it is calculated after the payment of tax. Like debenture, preference shareholder can be redeemable or irredeemable. Okay, so irredeemable preference share in reality don't work. In reality, preference share is not that much what you say visible in the market. We find everywhere ordinary share only. Okay, then talking about redeemable or irredeemable does not make much sense. Just for your understanding, you can remember this part that the cost of equity in the case of preference shareholder is the dividend what the company is paying. Okay, so that is divided by the price of the debt instrument. That will give you the cost of equity. Okay, so the preference share issued by the company which are redeemed on the maturity are called redeemable preference share. The so preference redeemable, those are called redeemable. This is the formula of irredeemable preference share. This is the formula of irredeemable preference share. For the case of redeemable preference share, it would have been dividend plus a redemption value minus net proceed by n whole divided by redemption value plus net proceed by 2. Same formula what we used in the case of debt, but in the case of debt, it was tax deductible. Equity, there is no tax deductible. The cost of redeemable preference share is similar to the cost of redeemable debenture. Okay, with the exception that dividend paid to the preference shareholder are not tax deductible. This is the formula what I've just now wrote. Okay, you remember this formula. And irredeemable preference share formula also I've written in the previous slide. And so the cost is equal to preference dividend divided by the price. The KP I'm writing as a cost of preference shareholder, that is dividend divided by the price. or price, or you can say net proceed, which is issue price minus your flotation cost. So see the numericals one by one. That XYZ issues 2010% preference share. So the dividend is 10 rupees. Okay, and the price is 95 rupees. What is the cost of preference share? That would be 10 divided by 95 into 100 you do if you want in percentage. Clear everyone? 1000 by 95. So if you do this, you'll get 10.53%. Any doubt, anyone? Now, going further, the next question, that if R Energy is issuing preference stock of 100 rupees per share, the price is 100 rupees with the dividend of 12 rupees. Okay, and then flotation cost is 3%, 3% of your price face value. Okay, you can say, because there's no face value here, so you'll calculate on the price only. Price is 100 minus 3% on 100. This, if you multiply with 100, you will get in percentage. That is your cost of preference share. You are getting it right. So this will be 1200 by 97. That is your cost of preference share. And this is the net proceed. Net proceed is nothing but issue price. Issue price is the market price minus flotation cost. If they are given flotation cost, it is always calculated on the price. Okay, then next question, XYZ issues 2000 10% preference share. So the preference share of 100 rupees, 100 rupees is the what you say redemption value or the face value or the price. 10% of that dividend is 10 rupees at 95 rupees each. Okay, and 95 rupees is the price the company proposed to. Now this is example of redeemable. Earlier was the example of irredeemable. So when you have redeemable preference share, when you have redeemable preference share problem, then this is the formula what we use. Your dividend is 10 rupees, redemption value is 100 rupees, your price is 95 rupees, and the life they have given is 10 year. Okay, so you just calculate it, you will get 10.76%. Okay, talking about the cost of equity share capital. So just like any other source of finance, the cost of equity is the expectation of the equity shareholder, where the different methods of the calculation of cost of equity are there. If the dividend is expected to be constant, then the dividend price approach is used. While if the earning per share is expected to be constant, then earning price approach is used. If dividend and earning are expected to grow at a constant rate, if we see dividend and earning are growing at a constant rate, then the growth approach called Gordon model is used. Okay, so then if it is difficult to forecast future, then realized yield approach is used. Okay, the cost of equity or the expectation of investor depend on the risk. Higher the risk, higher is the expectation, and then CAPM model is also used. Okay, CAPM model, basically it is a formula which says that RF plus beta into RM minus RF, where RM is the market return, RF is the risk-free return. Okay, and K is the cost of equity. Beta basically measures the risk on the underlying asset. Okay, so please understand that like you have, I believe you know about stock market and all. So whenever any company does a IPO, then the stock in the secondary market trade in the equity market, and we have basically two stock exchanges. One is Bombay Stock Exchange, and we have National Stock Exchange, over which we can see the movement of our stocks. So Bombay Stock Exchange, National Stock Exchange are basically the platform which gives us the facility that we can trade equities or shares over from them. So our market works from 9 o'clock in the morning to 3:30 p.m. So during this time, you can come and buy any company shares. Okay. And then these shares with companies which are trading in the market, you can divide these companies. Okay. You can divide these companies that are trading on the market either based on their market capitalization. Okay, you can divide this company based on their market capitalization, or you can divide these companies based on their business model or the sector which they belongs to. So based on market capitalization, your company can be either large cap, or your company can be either mid cap, or your company can be either small cap. But based on sector, we can say a company can belong to IT sector, or pharma sector, or FMCG sector, or mining sector, or cement sector, or automobile sector, okay, or banking sector, okay, or you can say energy sector, or real estate sector. Okay, there are many sectors are there, and of automobile is there, mining is there, then construction is there, and a lot of sectors are there. So primarily, you can divide this company under different parts. Large cap companies are those companies which have market value more than 20,000 crore. If a company is having market value between 5,000 to 20,000 crore, then it is called as mid-cap company. While if the company is having market capitalization less than 5,000 crore, then it is called as small cap companies. So many companies are there which are trading over the market. If you see on NSE, we have around 2,900 companies which are trading, while on BSE we have around 4,000 companies which are trading. What you can do to find the relation of the stock with respect to the market, we can use a term called beta. We use a term called beta. Beta basically measure the risk on the market risk of a stock. A beta primarily measures the degree of correlation what the stock is having with the market. Okay, the beta of the stock is either equal to one, or beta of the stock can be more than one, or the beta of the stock can be less than one. So if a stock is having beta less than one, they are called as defensive stocks. When the market become very negative, these stocks will give you good return, because any stock which have beta less than one means they will not give you very volatile returns. While any stock which have beta more than one, then the returns will be very volatile. So if you are looking to invest in that kind of company, which are less risky, then you can go for those stocks which have lesser beta. So beta basically measures the degree of correlation between the movement of market with respect to the movement of stock. Market here means Nifty and Sensex. What is Nifty and Sensex? If you don't know what is Nifty and Sensex, primarily when you divided the company based on the market capitalization, when you divided the company based on the market capitalization, so what we have done, we have taken the best, we have created a portfolio of best to best companies, and those best to best companies portfolio is called as Nifty 50. Nifty 50 is the, it's an index which measures the relative movement of best 50 companies. Then we have Nifty Next 50. Nifty Next 50 basically track the movement of of 51 to 100 company. Then we have index called Nifty 100. Nifty 100 track the movement of best 100 companies. And like this, we have lot of indexes, like we have Nifty IT, and then we have Nifty Pharma. Okay, we have Nifty Banking, and we, that is called Bank Nifty. We have Nifty Financial Service, that is called Fin Nifty. We have lot of indexes. We have lot of indexes, and primarily out of all these indexes, the most important indices is Nifty 50, and Nifty 50 is called as market because it is believed like hype. Uh, Eugene Fama efficient market hypothesis. It is believed that you can never beat the market. So the return what the market gives you, that is considered as the best of best return. Okay, so here like if you see in NSE, okay, in NSE website, okay, if I go to market data indices, okay, under the market data indices, I can see different indices, Nifty 50, Next 50, 100, 200. Okay, all sectorial indices also I can see. If you go to Nifty 50, you can see the best 50 companies of our country, and these 50 companies belonging to different sector. Like Britannia is a FMCG, ICICI Bank is a bank, Nestle is FMCG, Infosys is IT, HCL Tech is IT, TCS is IT, Hindalco is a metal, ITC is FMCG, Bharti Airtel is telecom, Maruti is automobile, Reliance is basically what you say oil and gas, and a Wipro, IT, Hindustan Unilever, FMCG, HDFC Bank, Tata Consumer Goods, but Bajaj Finance, Financial Service, Asian Paint, Chemical, SBI Life, Financial Service, Titan, Gems and Jewelry, JSW Steel sector, Tata Motor, Automobile, SBI Bank. So you can see we have best of best 50 companies, and the portfolio of these best of 50 companies, we believe that they'll give you the best return. Okay. And then if you're seeing market like today, market has fall down by 0.44%, you can see, but it doesn't mean that my stock has also fall down by 0.44%. Okay, they can be stock which has actually went up. Even then the market had went down, these stocks have went up. Okay, you can see many stocks which have went up today. So like ICICI Bank or Nestle or Infosys or TCS, they have went up. Even the market had fallen down, these stocks have went up. So beta you cannot calculate on single day because these all are statistical tool. And in order to work on statistics, you need lot of data together. More is the number of data, better would be the accuracy of the product. And again, there's no end to predict the accuracy of the product. So here, when we are observing the market, we have Nifty, which is the portfolio of the best 50 companies. Then we have lot of stocks. Okay, if the relative movement of the stock is compared with the relative movement of the market, then we can predict, then not predict, we can approximate the direction of the stock with respect to the market. If the market is going up by 10%, how much the stock is changing? Okay, then that is determined by beta. That if the stock beta is 0.5, that means that when the market goes up by 10%, my stock goes up by only 5%. When the market fall down by 10%, my stock only fall by 5%. So whenever we are seeing beta basically talks about the relation of the stock with respect to the market. It's a statistical terminology. Okay, and these statistical terminology basically help us to analyze the the slope or the change of the return of the stock with respect to the return on market, with respect to the return on the market. Okay, so if we are trying to draw a straight line on this, so the slope of this line, so the slope of this line, this is what you have called as beta. This is what you called as a beta. So beta gives you a value between minus 0 to 1 or minus 1, whatever. Negative beta means the movement of stock is reverse of the direction of the market. While if the stock is having beta equal to 1, it means that when the market has went up by 10%, your stock will also go up by 10%. When the market goes down by 10%, your stock also goes down by 10%. That means your stock is having the beta of 1. If any stock is having beta more than 1, maybe 1.4, they are considered risky stock because when the market is went up by 10%, the stock has went up by 14%. When the market has fallen down by 10%, the stock has fallen down by 14%. So any stock which have beta more than 1, you can consider them as a risky stock. Vice versa, in the case when the stock is having less beta. So beta, when we say beta basically measures the systematic risk on the stock. Beta basically measures the systematic risk on the stock. Basically, when we talk about risk on a stock, we can have systematic risk or we can have unsystematic risk. Unsystematic risk we can minimize by using portfolio diversification, but there is something called systematic risk or market risk, which we can never minimize no matter how efficiently we create our portfolio. So the term which measures this in the mathematical value, that is what we have a beta. So here, while talking about the model, so in order to work on cost of equity model, the problem in ascertaining the cost of equity is that here the dividend or the earning potential is not definite. Okay, as an equity holder, you either get the return in the form of dividend, or you might get a return in the form of capital appreciation. Here, here dividend is not guaranteed. If the company want, they'll give you dividend. If they don't want, they will not give you dividend. And since the life of the equity is considered infinity, doing this calculation of cost of equity is little bit complicated, and the accuracy won't be very much up to the mark. So different methods are given. Like if you assume your dividend to be constant, then there's a method called dividend price approach you can use in the term of earning per share. Because earning per share, this earning per share nothing but the part of earning per share will give to a shareholder as a dividend. So if the data is given about the dividend, then we'll follow dividend price approach. If the data is given about earning per share, then we'll follow earning per share price approach. If they are assumed to be grown at a constant rate, if the dividend is expecting to grow at a constant rate, then we have something called Gordon model. The Gordon model is nothing but DIV not 1 plus growth percent by price plus G. This is the cost of equity in the case of Gordon model. Then I'll discuss about something called realized yield approach, okay, and capital asset pricing model, the formula of which I have already discussed. So these all will help you in doing numericals based on cost of equity. Okay, this is the formula you can remember. Okay. So this is the formula for Gordon. These are a Gordon model. So we'll use a formula that the price of the share is equal to DIV1 by KE minus G. KE minus G. DIV1 is nothing but DIV naught plus 1 plus growth percent divided by KE minus G. DIV naught is a dividend for the present year, and dividend for the next year would be DIV1. Clear, everyone? And this is the formula you can use if you believe that your dividend or earning per share remain constant forever. Okay. I hope you all have understood so far. So see this numerical, a company has paid a dividend of 1 rupee per share of the face value 10 rupees last year, and the expected dividend is given for the last year. So that is a 1, and the growth rate is 1 plus 10%. And then the price is 55. If you can multiply with 100, you can get the value of cost of equity. Here, you can get the value of cost of equity. Uh, okay, the price is 100. Fine, everyone. So here, the formula is P is equal to DIV naught into 1 plus G divided by KE minus G. The growth rate is given. So the formula of cost of equity here, because this is not constant. If it's constant, then no problem. So in this case, it would be DIV not 1 plus G by price plus growth rate. This will be the formula. If you use the formula, you will get the cost of equity as 12%.